Hi, this is Craig Dunham, and I'm here with Chris Mowbray. And today we're going to talk through some questions that came up as a result of our LBO webinar conducted last week. Now, this webinar is the second in a series of 3 that focuses on corporate valuation. The third webinar will be on merger consequences and will take place on May 29th. All right, let's get started. Chris, global equity markets are in the midst of an impressive rally, and debt issuances have picked up. Do you see this as having a positive impact on the LBO market?
Well, considering the current rate environment and its impact on the debt markets, it's certainly an interesting time for LBOs. Historically low interest rates are driving investors to riskier assets, such as high-yield securities like high-yield bonds and structured securities, such as collateralized loan obligations. This gives sponsors the ability to raise the debt funding necessary to execute an LBO transaction. As we've seen with Apple, which recently completed the largest corporate bond offering in history, and Petrobras, which completed the largest bond offering in an emerging market, investor demand for debt is quite strong. Additionally, however, as the equity markets have rebounded, corporate valuations have subsequently increased, which could put a damper on potential sponsor returns.
Post the credit crisis, corporate balance sheets underwent significant deleveraging. Will sponsors be able to relever their balance sheets as they have been in the past?
Well, as we discussed in the webinar, sponsors will try to maximize the amount of debt that they can add in any transaction, and thereby reducing the amount of equity they have to put in to maximize their returns. Post-credit crisis, we saw corporations were quick to shore up their balance sheets by aggressively repaying debt and stockpiling cash. Many corporations now have huge cash balances, on their balance sheets, which means there's likely more room for leverage. While it's true that post the credit crisis, LBO deals saw a decrease in the amount of leverage, recent deals have shown sponsors have been able to add significant leverage to their deals. If we look at Heinz, which is the second largest LBO announced this year, at approximately $28 billion, second only to the recently announced Dell deal, pro forma leverage debt to EBITDA is about 7.6 times, which is a considerable amount of leverage.
All right. Obviously of utmost importance to any LBO is having a viable exit strategy. Although the equity markets have rallied a bit, the IPO market is still a bit soft. How will sponsors look to monetize their investments?
Right. So the traditional exit strategy for an LBO is an IPO or M&A. However, the IPO markets have been stagnant of late. So sponsors have had to seek alternative strategies. In the absence of your traditional exit strategies, sponsors can turn to a secondary buyout, which is a sale to another sponsor, or in some cases utilize a dividend recapitalization in order to return cash to shareholders. With the return of liquidity in the market, M&A and dividend recaps are becoming more plausible. Additionally, however, we've seen about 6,000 transactions, according to the S&P Capital IQ platform, in the past year where an investment firm is the seller. So that signifies that the M&A market is still quite a viable solution.
Chris, thank you so much for your time, and to our listeners, thank you for your time as well. Please join us on May 29th for the third in our corporate valuation series, which will be focused on merger consequences. If you have any further questions, please refer to www.spcapitaliq.com. Thank you.